Welcome back to Paisa Forever channel. Today we are diving into one of the most explosive yet misunderstood sectors in the global financial markets, uranium. If you have been tracking the energy sector, you know the narrative has shifted. We aren't just talking about green energy anymore. We are talking about energy security. And right now, the world is realizing that you cannot have a reliable, carbon-free future without nuclear power. But for an Indian investor, this market is tricky. It is opaque, highly regulated, and full of pitfalls. So, is it too late to enter, or is the real rally just getting started? To answer that, I have broken this down into 10 critical points that you need to know right now. We are going to look at the massive policy changes in India, the global supply crunch, and exactly how you can position your portfolio. Let's get into it. We have to start with the biggest domestic news. In December 2025, the Indian Parliament passed the SHANTI Bill, that stands for Sustainable Harnessing and Advancement of Nuclear Energy for Transforming India. For decades, nuclear energy in India was a closed shop. It was a complete state monopoly. Private players were not allowed to touch it. The Shanti Bill has dismantled that monopoly. It allows private firms, companies you know like Reliance, Tata and Adani, to step in and build nuclear reactors. Why does this matter to you? Because it unlocks an estimated $214 billion opportunity. This legislation essentially turns specific Indian infrastructure and power stocks into direct proxies for the nuclear boom. We are no longer just waiting for the government to build plants. The private sector's capital is now unleashed. This is a structural shift, not just a policy tweak. Now here's where many beginners get stuck. If you want to invest in gold, you can buy a coin, a bar, or trade it on the MCX. You cannot do that with uranium. Uranium is a controlled substance. It is a matter of national security. You cannot hold yellow cake in your demat account, and there are no commodity futures for it on Indian exchanges like the NSE or BSE due to safety regulations. This means you have to be smarter. You have to use proxy stocks. You are investing in the companies that build the reactors, supply the turbines, or the international miners who dig the metal out of the ground. If you're looking for a commodity trade like silver, this isn't it. This is an equity play. Let's look at the global picture. The price of uranium is driven by simple supply and demand, and the supply side just took a massive hit. Kazatomprom, the state-owned enterprise of Kazakhstan, is the world's largest producer of uranium. They are to uranium what Saudi Aramco is to oil. Recently, they announced a 10% production cut for 2026. That might sound small, but in this market it's massive. That removes roughly 8 million pounds of uranium from the global supply chain. The market was already in a deficit, meaning we consume more than we mine. This supply squeeze is the primary reason why analysts are forecasting global prices to push toward $100 to $135 per pound in 2026. When the biggest player cuts supply, prices usually have only one way to go. So, how do you play this in the Indian market? A lot of people search for the Uranium Corporation of India, or UCIL. Let me be clear, UCIL is a public sector undertaking, but it is unlisted. You cannot buy shares in it. Instead, you need to look at the beneficiaries of the government's target to reach 100 gigawatts of nuclear capacity by 2047. First, look at NTPC. They have a joint venture with NPCIL and are aggressively moving into nuclear power generation. Second, BHEL. They are the primary supplier of the turbine islands for nuclear plants. Third, L&T. Larsen & Toubro is one of the few companies with the engineering capability to build the complex reactor vessels and containment structures. These companies are the picks and shovels of the Indian nuclear rush. Sticking with NTPC for a moment, there's a fascinating development here. NTPC isn't just content with building plants, they are worried about fuel security. Reports indicate that NTPC is actively looking to acquire uranium mining assets abroad, specifically in Africa and Central Asia, to fuel its upcoming 60 gigawatts fleet. This is a major strategic pivot. It transforms NTPC from a pure utility company that buys fuel into a vertically integrated player that owns the fuel source. If they succeed in acquiring these assets, their valuation model changes completely. They become a partial play on the commodity price itself, which is a very bullish signal for the stock. Now, if you want pure exposure to uranium prices, not just Indian infrastructure, you have to look outside India. The direct route for an Indian investor is using the Liberalized Remittance Scheme or LRS. This allows you to remit up to $250,000 per year.
Using this, you can invest in US-listed ETFs. The two big ones are the Global X Uranium ETF, ticker symbol URA, and the Sprott Uranium Miners ETF, ticker symbol URNM. Why go through the hassle? Because these ETFs hold the actual miners, like Cameco and Kazatomprom. These stocks are up significantly. Cameco alone rallied roughly 160% in a year. Indian power stocks are great, but they are diluted by their coal and renewable businesses. These global ETFs are pure-play uranium bets. Let's address the elephant in the room. If you looked at the uranium spot price in 2025, it was boring. It stayed flat, bouncing between $63 and $83. However, uranium stocks rose about 40% in the same period. Why the disconnect? The market is forward-looking. The spot price stayed flat because utilities had built up inventory buffers. But smart money knows those buffers are running out just as the Kazatomprom cuts kick in. 2025 was the consolidation phase. 2026 is widely expected to be the catch-up trade, where the physical price of the metal surges to match the valuation of the stocks. Don't let the flat chart of 2025 fool you. It was the calm before the squeeze. This is the most exciting new variable: artificial intelligence. We all know AI is booming, but few realize how energy-hungry it is. Data centers powering AI models require massive amounts of electricity, and more importantly, they need it 24/7. You can't run a mission-critical data center on solar power that disappears at night or wind that stops blowing. Tech giants like Microsoft and Amazon are now demanding baseline carbon-free power. That's nuclear. This shifts nuclear energy from being just a boring utility play into a technology growth proxy. We are seeing a non-cyclical demand driver that isn't dependent on government budgets but on the balance sheets of the world's biggest tech companies. Small modular reactors, or SMRs, are the future of nuclear. Smaller, safer, and faster to build. In India, the race has already begun. Reliance, Adani, and Tata Power have all signed non-disclosure agreements with the government to co-develop Bharat small reactors. The bid deadline is March 2026. This is significant because it validates the technology. These conglomerates don't put money into science experiments. They put money into scalable businesses. Their involvement confirms that private capital is committed to this sector. Keep an eye on the news in March 2026. The winners of these bids will see a significant sentiment boost. Finally, we have to talk about the risks. No investment is a sure thing. First, geopolitics. A lot of uranium comes from unstable regions. Niger, a major producer, has seen political coups and is pivoting to sell its uranium to Russia and Iran instead of the West. This creates supply chain volatility. Second, for Indian investors using the LRS route, remember the tax collected at source, or TCS. If you remit more than 7 lakh rupees in a financial year, you are hit with a 20% TCS. You can claim it back when you file your returns, but it locks up your capital upfront. That increases your entry cost. You need to factor that 20% cash flow hit into your investment calculations. Before we wrap up, I want to quickly bust 3 myths I hear constantly from Indian investors. Myth number 1. Uranium is just like gold, a safe haven asset. Fact, it is not. Uranium is a high-volatility industrial commodity. It crashes when reactors shut down, and it spikes when demand exceeds supply. It does not protect you from inflation, it leverages global energy demand. Myth number 2. I can just buy shares of Uranium Corporation of India, or UCIL. Fact, we touched on this, but it bears repeating. UCIL is not listed. If someone tells you they are selling you pre-IPO shares or grey market shares of UCIL, run away. It's likely a scam. Stick to listed partners like BHEL or L&T. Myth number 3. Solar and wind will replace nuclear soon. Fact, solar and wind are intermittent. Their capacity factor is roughly 20 to 30%. Nuclear has a capacity factor of over 90%. As industrial growth and AI demand surge, grid stability becomes priority. You literally can't run a modern industrial economy on intermittent power alone. Nuclear is the essential partner to renewables, not the enemy. So here's the bottom line. The uranium market in 2026 is sitting at the intersection of a supply shock, a technological revolution in AI, and a historic policy opening in India. The SHANTI Bill has opened the door for domestic growth, while the global supply crunch from Kazatomprom provides the price catalyst. Whether you choose to invest in Indian infrastructure builders like NTPC and L&T or take the direct route via global ETFs, the data suggests the wind is at the back of this sector. Just remember to manage your risk, understand the tax implications of foreign investing, and look at this with a long-term horizon. This is an infrastructure cycle, not a day trade. If you found this breakdown helpful, make sure to hit that like button and subscribe for more deep dives into the markets. I'll see you in the next video.
Disclaimer: this video is for informational purposes only and does not constitute financial advice. The market involves risk, so please conduct your own research before investing.